All right, let's talk about one of the biggest challenges for any UK founder, securing that crucial early stage funding. Well, what if I told you there's a government-backed way to make your startup wildly attractive to investors? Today, with the help of the experts at My Tax Accountant, we're diving into the SEIS and EIS schemes. We'll be using all the latest rules, fresh from the 2025 budget, to give you a clear roadmap. Getting this right isn't just a small win, it can be the difference between your idea taking flight or never getting off the ground. And if you think this is just some optional extra, think again. This isn't a nice to have. For many, it's a must have. Just look at this quote. A report from the British Business Bank found that more than half of angel investors in the UK won't even look at a deal unless it's SEIS or EIS eligible. Why? Because it massively reduces their risk by giving them incredible tax relief. For an investor, it's a no-brainer, which means for you, it's a deal breaker. And that's exactly why we've teamed up with the experts at My Tax Accountant for this. You know, these guys are in the trenches with founders every single day, guiding them through this exact process. They see all the common mistakes, all the little traps people fall into, and they've helped us lay out a clear roadmap so you can avoid them. So here's our game plan for today. We'll kick off with the big picture, then we'll get into the nitty-gritty. Is your company eligible? And then, are your investors eligible? Next, we'll walk through the actual HMRC process, cover the super important 3-year rule, and then wrap it all up. Sound good? Let's get started. Right, first up, the SEIS funding game. Before we get lost in the rules, let's just take a second to appreciate the sheer scale of the opportunity we're talking about here. Just take a moment and look at this number, £27 billion. That is a staggering amount of money. It's not just a statistic. That represents over 52,000 companies just like yours, that have received the funding needed to grow, all thanks to these schemes. This is the engine room of the UK's startup economy. So you've got two flavors here, SEIS and EIS. Think of SEIS as the early stage rocket fuel. It's for the brand new, super early seed stage companies. And because the risk for investors is higher, the reward is bigger, a whopping 50% tax relief on their investment. Then there's EIS. This is for companies that are a little more established, and it still offers a fantastic 30% tax relief. Now, here's the golden rule, the one thing you absolutely cannot forget. SEIS always comes first. You use that, and then you can move on to EIS. If you do it the wrong way around, you have locked your company out of SEIS forever. No second chances. Okay, that brings us to the first massive hurdle, making sure your company actually qualifies. You could have the best idea in the world, but if you don't tick these boxes for HMRC, you're going nowhere. Right, let's look at the hard numbers, and these are hot off the press, confirmed in the 2025 budget. For SEIS, that's the seed stage, remember, you can raise a maximum of £250,000 in total. Your company must have less than £350,000 in assets before the investment, be trading for less than 3 years, and have fewer than 25 full-time staff. Now look at the jump to EIS. The scale is way bigger. A $12 million lifetime limit, under $15 million in assets, less than 7 years from your first sale, and under 250 employees. It's a clear step up. But it's not just about the numbers. HMRC has some very strict rules about what your company actually does. They call it a qualifying trade. And what they're looking for are innovative, high-growth businesses, not safe bets. So if your company is mainly involved in things like property development, banking, or legal services, things generally seen as lower risk, you're probably out. The rule of thumb is the 20% rule. If more than a fifth of your business comes from these forbidden areas, you won't qualify. And this next point really gets to the heart of what the schemes are all about. It's called the risk-to-capital condition. It sounds technical, but the idea is simple. You have to prove two things to HMRC. One, that your company genuinely plans to grow and develop over the long term. And two, that there is a significant risk an investor could lose their money. This is HMRC's way of filtering out safe, predictable ventures that are just looking for a tax break. They want to fund real entrepreneurs taking a real shot at something big. Okay, so your company checks all the boxes. Fantastic. But that's not all. Here's where most people go wrong. Let's talk about investor eligibility. This is just as critical, and it's full of potential pitfalls. This is probably the single most important rule on the investor side, the 30% substantial interest rule. An investor, put simply, cannot own more than 30% of your company. This includes their shares, their voting rights, all of it. And why is that? Well, the government wants these schemes to attract new, external money into your business, not just to give a tax break to people who already own and control it. Now, here's where it gets a little bit tricky. That 30% limit doesn't just apply to the individual. It also includes their associates. So that means their spouse, parents, children, and even their business partners. All their shares get lumped together. But here's the bizarre quirk that always catches people out. Siblings do not count as associates. I know, it makes no sense, but that's the rule. So an investor's father would be an associate, but their brother would not. You have to know these little details. And here is a fantastic pro tip directly from the team at My Tax Accountant. This one is about employees versus directors. An investor cannot be an employee of the company when they get their shares. Simple. But what if you want them to be a director? That's okay, but the timing is absolutely critical. They must be issued the shares first. Then, even the next day, they can be appointed as a director. If you get that sequence wrong, their entire investment is disqualified for tax relief. It's that precise. All right. Your company's good, your investors are good, so what actually happens next? Stay with me. This next part covers the practical steps with HMRC, and understanding this process will save you a ton of headaches later on. Think of the process in 2 key stages. First, you have advance assurance. This is an optional step, but honestly, it's highly recommended. It's like sending your plans to HMRC beforehand and asking, hey, does this look like it's going to work? It gives your investors massive confidence. The second stage, which happens after you've received the investment, is the compliance statement. This one is mandatory. This is the official form that tells HMRC you've done everything by the book, and it's what allows your investors to actually claim their tax relief. Now, one of the most important things you need to do is manage your investors' expectations. They can't claim their tax relief the day they transfer the money. First, you have to actually use the funds, either by trading for 4 months or spending 70% of the money raised. Only then can you file the compliance statement with HMRC. Then you wait for HMRC to approve it and issue the certificates, known as SEIS 3 or EIS 3 forms. You send those to your investors, and then they can finally claim their relief. The whole process can take several months, so be upfront about it. So you've navigated the rules, filed the paperwork, and the money is in the bank. You can finally relax, right? Well, not quite. Securing the investment isn't the finish line. It's the starting gun for the crucial 3-year compliance rule. This is so important. For 3 full years from the day those shares are issued, both you and your investor are on the hook. For that entire time, your company must continue to be a qualifying company, doing a qualifying trade, and the investor cannot sell their shares or become connected, for example, by becoming an employee or going over that 30% ownership limit. Only after those 3 years are up do the tax reliefs become permanent and irreversible. And believe me, the consequences for getting this wrong are severe. If any of these things happen during that 3-year window, HMRC can claw back the entire income tax relief from the investor. This means your investor could get a sudden, unexpected tax bill for tens of thousands of pounds. Imagine having that conversation with someone who backed your dream. It's a huge financial risk for them and a massive reputational risk for you. Phew. Okay, we have covered a lot of ground. From company rules to investor rules, the process with HMRC, and that all-important ongoing compliance. Let's pull this all together and talk about what to do next. At the end of the day, this is what it's all about. Navigating these rules isn't just about paperwork. It's about strategically positioning your company to unlock the capital you need to build your team, develop your product, and truly supercharge your growth. The complexity is absolutely worth it because the prize is so significant. Now, it is absolutely crucial to say this. All the information we've discussed is for general purposes only. Your business is unique, the rules are complex, and you shouldn't rely on this alone to make financial decisions. Before you do anything, you must consult with a professional who can look at your specific situation. And for that expert, tailored advice, we highly recommend getting in touch with the team at My Tax Accountant. They are specialists in SEIS, EIS, and all sorts of other tax matters, and they can give you the specific guidance you need to get this right. Their contact details are on the screen now. Give them a call. It could be the most important step you take on your funding journey. Thanks so much for joining me.